Hello and welcome to the second lecture in our venture capital and angel investing series. And this is on terminology in angel investing and venture capital. So the reason why I did this lecture second is I didn't want to go to the main sort of parts of the lectures without having the definitions, because there's a lot of pieces of terminology that we casually use in the industry. And I think that if I went into the lectures and was trying to define them bit by bit, it would be really difficult and it would slow me down. So this is a pure terminology lecture where I'll be talking about all the different definitions that I could think of that you might need to know as we go into the longer form lectures on venture capital and angel investing. It's also a lecture that you can come back to. So if you ever want to go into a meeting, say, or you're reading a contract or you're reading an agreement or a term sheet and you're seeing a lot of terms that you don't quite remember the meanings of, then you can quickly come back to this lecture, and hopefully most of the terms that you will come across in the investing world will all be in this lecture. So I'm going to go through them very quickly. The first one, and the big one, is valuation. Valuation, especially in early stage tech, is a very, very dramatic term because it's the most contended term, I think, in venture capital. How do you value a business that has absolutely no track record, that you're not even sure what the technology is or what it can be? It's just an emerging technology. And sometimes it's even just an idea and it hasn't just started generating revenue yet. How do you get to the valuation? And we're going to discuss this in our lecture on valuation and due diligence, but this is just the definition. So valuation is a process by which analysts determine the present or expected worth of a stock, a company, or an asset. Deal sourcing. So we have a lecture on deal sourcing coming up, but just so you know what it is, deal sourcing or deal origination, as it's also known, refers to a process by which venture capitalists and angel investors and corporate development experts and other finance professionals use. It's through this process that they attempt to find investment opportunities within the market. So a lot of people ask me, how can you find deals? Like, how do you find the startups in the first place? And this is the process of deal sourcing or deal origination. Fund thesis. A fund thesis, or for the angels, an investment strategy, is a core reason or the core sort of structure that you build your investments around. And it usually combines the fund manager's skills and expertise with the market opportunity to generate superior returns. And it was Chris Stovers who said in the venture business, there are a lot of very smart people, but not necessarily differentiated. Very interesting observation. So before you even go into investing, I think it's very important to think about what your thesis is, where you feel that you have a certain level of expertise in investing. And that's very, very important for venture capital. Not so important for angel investors, but still, if you're angel investing on a large scale, then it's important to think about, is this the right type of angel investing for me to do, and what am I really building my portfolio around? A well-established strategy blends macro trends data with obviously the fund manager's insights and expertise and analysis. What's a convertible note, or what's convertible debt? Even really experienced Nigerian bankers who typically work in microfinance or credit don't understand what these instruments are. And these are the most used instruments in venture capital and in angel investing when you're working in tech. So a convertible note, otherwise known as convertible debt, is a loan. Just like you're giving UBA. It's a loan from investors, which then converts into equity. So it's a very, very common way that investors invest in early stage startups, particularly ones that don't have a valuation. So instead of arguing over valuation in the early stages because you don't quite know what it's worth, you actually give the person a loan. And then when they're able to raise money at a specific valuation, because you're an angel, you might not have all it takes, or the business doesn't even have anything in the first place. It's just somebody has come to you with a PowerPoint. How do you value somebody that comes to you with a PowerPoint or a sheet of paper saying this is my idea? And you don't necessarily have the expertise, you're an early stage angel, you don't have an office that is doing this for you, then you can give the person a convertible note and say, look, I'm giving you this convertible note, and when at a time when you have a formal capital raise, then this will convert to equity. Now, the danger of that is if you're investing in a small business, say, you know, your daughter's hairdressing outfits, or maybe, you know, somebody's restaurant, then they might never raise equity funding. So it doesn't convert to anything, but then you still have the interest on the loan. What's a safe note? A safe note is another really common instrument that we use as practitioners in the venture capital and angel investing space. And a safe note, or a simple agreement for future equity, was actually invented by one of the most famous accelerator incubators in the world, Y Combinator. And they are notes, they are documents that startups use to help raise seed capital. Essentially, it's a promise, not a loan, just a promise that allows an investor to purchase a specified number of shares for an agreed upon price at some point in the future. And I know what everybody is thinking. Safe note, convertible note. Why don't we just buy the equity or buy the shares directly? When I'm buying shares on the Nigerian Stock Exchange and I'm going to, let me think of a listed company now, one of those palm oil companies, Okumu Oil, for instance, correct, Okumu Oil. You buy the shares, you go to your dealer and you say, look, I want Okumu Oil shares, or I want Presco. That was the one that I was trying to think of, Presco shares. And they give you the shares. So what is the need of this safe note, or what is the need of this convertible note? But early stage startups are not Presco or Okumu. Okumu, you know the profit after tax. You know everything about Okumu. There are audited accounts for like 7 years about Okumu, validated by the Nigerian Stock Exchange and overseen by SEC. This is usually a guy with an idea, maybe has not even started generating profit yet. So how do you know what you are even investing in? And what if the person doesn't even have the legal infrastructure to allow you to invest? Then you use a safe note, and at a specific time, you will, the safe notes, or what was promised in the safe note, will be converted into shares. But I don't want to talk too much about this because there's a whole lecture at the end, towards the end of this lecture series, on legal structures in venture capital, where I'll be taking a proper deep dive into safe notes and explaining a bit more. What's an exit? An exit is the process by which venture capitalists realize their returns. And this is what we all hope for when we invest, that we get to exit. And venture capitalists can exit at different stages with different exit strategies. So when you invest, at some point, if you're doing angel investing or if you're doing venture capital, you're hoping for an exit and you're planning towards an exit. And right from the time of investment, most probably you're thinking about your exit. And we'll be talking about exits in the last lecture as well. Pro rata rights. This is from the Corporate Finance Institute, and I really like this definition because it's a right, but not an obligation, that is given to an investor to maintain the initial percentage ownership in subsequent funding rounds. So what people don't realize about this early stage startup investment is that you can invest as the first investors and get a certain amount of ownership. But that ownership, when subsequent investors come, can be diluted. So it can be diluted down. So your pro rata right gives you a right to say, no, I want to maintain my ownership and I'm going to add more money to maintain my original ownership. So that's a pro rata right. What's an equity stake? An equity stake is the percentage of a business owned by the holder of some shares of stock in that company. What's anti-dilution? I spoke about dilution earlier, that you can be diluted. So an anti-dilution provision are the kind of clauses that allow investors a right to maintain their ownership percentage, or a degree of their ownership percentage, in the event of new share issues. And I'll speak about that a bit later when we go into the legal terms. Preferred shares. Preferred shares are sometimes known as preferred stock or preference stock, and these are securities that represent ownership in a corporation that have a priority claim over common shares on the company's assets and earnings. So they're like the tier 1 shareholders, sort of the superior kind of shareholders that have different rights from the common shares. And you might say, why is it important to know? Brothers and sisters, it's important to know. In my early days of investing, I didn't look at the document very well, and I was issued common shares. It was only when we got to the point of exit that I realized that they told us that, look, no, there are preferred shareholders that will get a certain amount of money, and you ordinary shareholders will get something else. So it's really important to look at these things, and that's why I'm giving you all the definitions now, so you can keep your eyes peeled for these kind of things. Liquidity preference. A liquidation preference represents the amount of money that a company must pay at exits to preferred investors. A rolling fund. Rolling funds really changed the investing in startup business. They are structured as limited partnerships, but they have a new set of LPs practically every quarter. So a new fund is launched every quarter, and it just allows people to raise small amounts of money in quicker amounts of time. And a lot of people are doing these rolling funds now, and it's changed the venture game. I would say it was just as powerful in terms of how it disrupted the venture game, or how it changed the venture game, as to when banks started doing electronic transfers. It just democratized VC in a way that wasn't possible before. A micro VC. So the American definition of a micro VC, that's a small VC, is a vehicle that has less than $50 million. In the Nigerian context, that's not a micro VC. I think the biggest VCs in Nigeria probably have raised $50 million to invest. In fact, those are massive, mega VCs in the Nigerian context. So in the American context, a small VC would have $50 million. How much is that in there? I think it's around like 25, 30 billion. That's small in American terms. But in Nigerian terms, probably a micro VC would be, I would say, probably under $2 million, maybe under $1 million would be a micro VC. Whereas, you know, a $10 million fund in Nigeria is not a micro VC. That's a significant VC. What's a super angel? Super angels are investors with high net worth that participate in investing into companies during their seed stage. And these investors exchange their investment in startup companies for equity stake. And that's why I say the lines are getting blurred between VCs and super angels. Because a super angel, you know, probably does the same amount of deals as a VC, and probably writes similar sized checks as well. That's why they're called super. So, you know, they're kind of in between the angel investor and the VC. What's venture debt? Venture debt is a form of debt financing for venture equity-backed companies that lack the assets or cash flow for traditional debt financing. And we're one of the few finance houses right now in Nigeria that offer venture debt. It's quite a specialist product which is different from bank debt. In fact, if you go to a typical Nigerian bank as a startup and say that you need debt, what do they ask you for? They ask you to go and bring land, your father's house, your warehouse, something physical that you can use to collateralize, something that they can seize. Venture debt, you don't usually have anything that you can seize. And it's quite a specialist asset class. So I'll be speaking more about venture debt as well in the subsequent lectures. What's a term sheet? A term sheet is a non-binding agreement that basically shows the terms and conditions of any investment that you're making. What are accelerators and incubators? An incubator helps entrepreneurs flesh out business ideas, while accelerators expedite the growth of a minimum viable product. So incubators operate on a flexible time frame ending when the business has an idea or a product to pitch. What does carried interest mean? Very important, particularly in VC, but also if you're a member of an angel collective. And carried interest is a primary way that partners get paid for managing a venture fund. So the carried interest is when a company reaches the point of exit, what you get out of it as a GP compared to what the LP gets out. Operator angels. So I told you about super angels. I'm now going to tell you that there's another species of angels again, operating angels or operator angels. So operator angels have operated a business before. And the reason why we differentiate operator angels is because most people, like I say, that go into angel investment or go into VC might not necessarily be people that have operated a business before. Actually, I lied there. Angels typically have operated a business before, but VCs typically have not operated a business before. So we call, when somebody introduces themselves as an operator angel, what they're trying to say is I've operated a business before, I've worked at a high level in a business before. So an executive, say in Dangote group of companies, or an executive, I keep on using the Dangote or flour mills as if they are the only companies in Nigeria. Please, I need another company. Unilever. So an operator angel that is somebody that has perhaps worked in Procter & Gamble at a high level, that has actually operated a business before. That's what's called an operator angel. And there are also operator VCs that come from industry that have operated a business before. I was COO at Procter & Gamble. I was COO at BUA. These are what you call an operator angel. And if they go into VC, you call them operator VCs. So that comes to the end of my lecture on the terminology. We'll now be going into talking about structure and thesis of a VC fund.